right, there you have it, folks. History is rhyming. Gold is at new highs, silver is not. Same thing that happened in 1978. The futures traders are getting frantic, but the ETF traders are asleep. It means we've got a lot of fuel left to this rally. There's a long way to go. It's going to get scarier. It's going to get more volatile, which is why we have to keep in mind always what money actually is. It is simply the most liquid commodity traded in an economy. Gold's name is going on with the ETFs. We've seen outflows on price increases, but they've been very rare, but now they are getting very intense. And if gold is flowing out of the paper funds, who or what is buying it?
Gold prices soared to new heights this week, with the precious metal rising by more than 5%, last trading above $2,150. Rafi Farber highlights that silver also rallied, last trading at $24.30. The pulsing 9% rally in silver saw it outperform gold to the upside, with the gold to silver ratio falling from 92 to 89 in the past 5 trading days. The sharp move higher in precious metals occurred despite the calm in equity and FX markets, with the American index rising 1% for the week. Gold also rallied despite lukewarm sentiment and modest investor positioning, which bodes well for the price outlook, said Rafi Farber. The momentum continues across the board, including Bitcoin, which just reached new all-time highs this week as well. Now we'll show you excerpts of the latest Rafi Farber interview talking about the recent gold price breakout and sharing his price prediction for 2024. But first, hit the like button, smash the subscribe button, and turn on notifications bell, as those who watch our channel make better decisions as they're better informed. Enjoy the video.
And it's not just the ETFs, it's all gold holdings across all transparent funds. We have an open interest explosion of close to 20% in the last 4 trading days. So there's a lot of people or a lot of big institutions buying futures, but not the ETFs and not the other paper funds. The BTFP, the Bank Term Funding Program, ends on March 11th, and the bulk of loans are due 1 month later, around April 11th, April 12th, something like that. I think it's about $70 billion. And if we are to look at the value of treasuries from when the BTFP kicked off to now, treasuries are even more underwater when they were back then. We're going to begin with the GLD ETF, and this is representative of gold funds generally. We've seen a big trend change, or a big sea change, more appropriately, in the gold holdings of the GLD ETF, and other ETFs are mimicking this. So we see here in 2022, right, gold is trending down into the 2022 bottom, and this corresponds to the 1976-77 bottom in gold and silver. So we have here falling holdings and a falling gold price, which makes sense. And then here in the blue, we have a rising gold price, and we have a slightly rising GLD holdings into around June of 2023. And then we have another falling in the gold price down to this low over here, wherever it was. And again, we have a corresponding fall in GLD holdings. But here, look at this. So we have another slight rise in holdings with the rise in price until we get to around the beginning of 2024. And then 2024, I mean, look at this. We have gold going pretty much vertical here at the price of GLD going, approaching, I think it's $200 a share now. And we have even higher volumes of gold flowing out of the ETFs. So something is going on here. Gold is being vacuumed out of the ETFs, and we have very high volume in futures and a lot of open interest. We're going to go into that in the next slide or two. So here I just wanted to show you that it's not just the ETFs, that the outflows in gold across all paper holdings, all funds, all transparent funds, we see here that over the last 3 days, as gold has really climbed pretty strongly, we have a loss of about 100,000, another 200,000 and 300,000. That's about 600,000 ounces of gold in the last 3 days as the gold price has rocketed higher. So something is going on here. This, to me, makes it look like this is a banker war of banks versus high net wealth individuals. if the ETFs aren't being chased here, retail is not involved, and I don't think premiums have risen that much, so the stackers aren't really that heavily involved in this rally, which means we got a lot of fuel for this to go when they do become involved. And I would not recommend waiting for them to get involved in order to acquire more stacks if that is in your plans. I'm not one to wait for price to hit a certain target to add to my stacks. I do that every month anyway. I want to show you here what is going on in open interest. This is pretty extreme, and this is up to March 6th. So we have here the two numbers from the CME website. This is from February 29th, and we see here 424,082 contracts, and that was a change of 12,393. So if you take 424,000, take away 12,000, and you get how much open interest was in gold on February 28th, right? Simple math. Then you take what we have on March 6th, that's 487,545. So we have banks that have to take this paper crap back onto their balance sheets. The reverse repos probably have until the end of March, early April before they zero out, which is going to be around the same time that Bank Term Funding Program loans given out in April have to come due and be paid back to the Fed, which is going to smash down the monetary base and threaten something happening in the plumbing in the repo market. We went over last week the 1970s in silver. They are also repeating themselves in gold relative to silver. We'll go into the charts that show this. So while it might not feel like it, everything is going according to historical patterns that we've seen in the last 50 years. There is no reason to think that those patterns will change because human nature is basically the same as it was back then.
In the precious metals market, Rafi Farber highlights a notable shift. Investors are moving from gold ETFs to futures as gold prices rise, betting on future prices rather than holding current shares. Farber compares this to trading a secure asset for the potential of greater future gain, with the expectation that the value of gold will continue to increase. This situation mirrors the volatility of the 1970s gold and silver markets, suggesting potential upcoming shifts in metal prices. Farber uses this historical context to predict future market movements. With Farber's analysis, investors are navigating a market full of opportunities and risks. The shift from ETFs to futures, informed by historical patterns, suggests that understanding past market changes is key to managing future uncertainties in gold and silver trading. For more of Farber's insights, remember to subscribe and like this video. Enjoy the video.
Bars down here, this is the volume. This is the volume spike, goes up to about 125 million shares being traded in a week. This is weekly bars. So we see here there was a volume top here, which signals a top in the gold market. And we saw here again, this is 2 years ago, actually, March 7th, 2022. That was nickel Armageddon, when the nickel market nearly blew apart the LME and all derivatives across the world with it. So we had a huge volume spike here and a high in gold. And now, look, we're here at a new high, and oh, there's nothing doing over here, no volume. Nothing is being chased here in the ETFs. This is very, very strange. So the banks are up to something, and the retails and the stackers are not getting involved yet. We've got a lot to go in this rally, according to my calculations. And now I want to show this important chart that can help you visualize what might happen when the bulk of loans come due on the BTFP, the Bank Term Funding Program. The title of this chart is Treasuries Are Even More Underwater Now Than When BTFP Started. The blue line is the BTFP loans, right? So we see here, March 2023, they are at zero. The BTFP gets started. There's a misconception here on March 11th when the BTFP expires, all these loans are going to come due. That's not true, because on March 11th is when the eligibility for the loans started, but the loans weren't taken out until about a month later in bulk. So here, this I think is April 11th, April 12th, something like that. And we have about $80 billion of loans coming due at around April 11th. So that's when a lot of the mayhem, if it happens, is going to be felt. Or a lot of the impact, I shouldn't say mayhem, I should say impact, whatever it's going to be, I don't know. But we see here, these are the 10-year treasury yields representative of the value of treasuries. So the lower these go, the higher the value of the treasury bonds, and the higher they go, the lower the value of the treasury bonds. So we see here, when the bulk of loans were taken out, right? What were 10-year interest rates? They are somewhere between 3.4 and 3.6% over here, right? And this is when they were already underwater. And now we have a year later, and where are yields now? Where they're going to have to take these bonds back, these treasuries back onto their balance sheets at what yield? At around 4.1, 4.2%, something like that. They're even less, they're worth even less now than they were when the program started. So the banks are going to be in trouble again. And what's going to happen? Oh, there's going to have to be another bailout somewhere. Who knows where, when, what, we know why. Let's go into the RRPs. We are winding down on this program, and I will show you why I think that by the end of March, beginning of April, these are going to zero out. So I have 3 days highlighted here. This is what generally happens to the RRPs, and there's like 440 billion left, or 430 billion, something like that. So here we have the 3 dates of the first business day of April, right? And each time, April 2020, RRPs were down 77 billion. April 1, 2022, they were down $206 billion. April 2023, they were down $154 billion. And if we see something similar this year, down 150 billion, that should bring the RRPs down to maybe 200, 250 billion. And then you have April to zero them out. We have tax day in April, which is a big drain on reserves because a lot of money goes from the monetary system into the Treasury's bank account at the Fed, taking it out of M2. That should also cause some stress on the RRPs. We have a few weeks to go on this, and it should correspond to around when the BTFP expires, and that's going to cause some monetary stress. We'll see what happens. It's going to be interesting. And finally, let's go back to the 1970s. Last week, we dealt with silver. The fact that it did not move. This is the bottom chart in silver over here. Silver had a double top in 1974, corresponding to something along the lines of the August 2020 top and the February 2021 silver squeeze top, and then 5 years of nothing into early 1979. So we see here what was happening in gold, right? We have gold in the current situation, gold breaking out to new all-time highs. So this was the all-time high of gold in 1975 over here, early 1975, and then we had a low about 2 years later, 1977. And then we have gold achieving new highs here in early 1978, right? At this time, silver was still struggling. It did not reach new highs in 1978, which is, as I said, around where we are today. So you have the same situation today where gold is reaching new highs, but silver is not. According to this chart, we have about another year until the silver and gold major breakout to all-time crazy highs of monetary crisis levels. It could be less than a year. Nothing is exactly the same. Patterns do not repeat exactly, but they rhyme. So you got to be ready for it now, even though according to this chart, we're about a year out.
What do you think of today's episode? Do you agree with Rafi Farber? Post in the comments section your price prediction for silver for the end of 2024, and if you think this price breakout will continue. Share this video with a gold bug and watch this one because you'll love it. I see you on the other side.